Good morning, good afternoon, or good evening, everybody. Welcome back to another episode of the Fit Finance Sessions. It's just the two of us today, Tom and Tim, or Tim and Tom. And today we thought we'd just give you a bit of a short and sharp update on the market in general, particularly sort of property market, crypto actually, which has got slightly more interesting than it has been over the last couple of months. So we'll go into a little bit more depth on that in a minute, and then just stocks in general, and just give you a bit of a snapshot as to what's going on. So as I say, in that order really. So property, I think Tom's got a few bits and pieces to kick off. I mean, what's been going on there, Tom?
Yeah, I think there's been some interesting articles in the FT recently about the property market and are we in a boom, aren't we in a boom? I think there's definitely demand, and I think if you look at some of the articles recently on the property market and what's going on there, you can see across all the major OECD countries, there's definitely a rise in demand and rise in prices, and I think that's largely due to a change in how we're using property, but also because rates are staying low. And I think the other thing, I don't know so much about other markets around the world, but in the UK, the mortgage market itself is becoming more competitive. And I think banks are actually producing some pretty good results in terms of earnings, but luckily for consumers, there's more competition between a lot of the lenders because of this demand. They know there's a lot of demand there, so there's money to be made, but it's forcing lenders to be more competitive with the rates. And HSBC, which for retail lending in the UK has generally been one of the smaller players, despite being one of the major banks, they've definitely had a big push. And I know with clients in particular, we've seen them come through with some good rates. That's not us promoting them or anything. I think it's just conditions of the market. If you want to move, I think you've got to be conscious that we might be in a bit of a bubble. And I know particularly around here, it's a lack of supply. There's plenty of people who want to move, but they can't find the place they want to move to. So that's reducing supply. And therefore, when people do bid on houses, you're getting this sort of bidding war. But equally, if you're staying put, rates are super cheap and it's a very competitive market, it might be worth sort of locking in now for longer, or just revisiting your lending options. I know there's sometimes early repayment charges and other things, but if you're going to stay in the home that you've been in for a long period of time, there's some really cheap long fixes out there. I think Barclays do a 7-year at 1.5% if you've got a 25% deposit, something like that. Money is cheap on that basis, and with inflation coming through, only ever helpful on that period. So are we in a bubble? Maybe, but I think lots of assets are in bubbles, and I think when we come back to markets, you're seeing that in lots of different things. And one of the inflation hedges often referred to is crypto. So whilst that's been a bit of a roller coaster, Tim, what's been going on there?
Yeah. So actually, the last couple of weeks, months, it's been rather boring, to be honest with you. Everything falling down in prices and what have you. Anybody who listens to this who tracks the prices of the main ones, Bitcoin, Ethereum, Ripple, etc., would have seen a volume spike big time. There's a lot more money flowing into Bitcoin in particular, just keeping with the mainstream one. And actually, it's just hit over the weekend. It hit £30,000 for the first time in a good couple of months. So it was rising for, actually I can tell you here, it was rising for 1, 2, 3, 4, 5, 6, 7, 8 days straight, quite clear and cut. So things are, there's definitely been a shift of momentum there. Looking more generally though, there's sort of good and bad news really on the horizon for it as an asset class, if you like. Starting with the good, as of today actually, 4,000 special fund classes in Germany have now been permitted to put up to 20% of their portfolio into cryptos. So again, a lot of that's essentially a big door worth of liquidity that's potentially been opened up to the institutional side of things. There is, however, this sort of infrastructure bill, which I'm sure we'll come back to in a bit, more generally on markets. But one of the elements to that bill is this natural desire, and won't be, it's not new news, but this desire for more regulation and what have you around cryptos and a way to tax it, basically. One of the main elements to it is this idea that cryptocurrencies will be classed as a security, as a version of security, basically, which sort of puts it into the same party as stocks and shares, isn't it? So naturally, that then brings into all sorts of other regulatory reporting requirements and what have you, mainly to do with identity, though, so sort of KYC, that sort of stuff. So, for example, at the moment, 2 different brokers don't talk to one another, i.e. if you've got one Bitcoin over here on Binance, for example, and you transfer it over here to Kraken, those 2 parties won't talk to each other. In the new proposal, it's proposed that Binance, in this example, would have to report cost, sort of the cost basis, whatever that the client bought the one Bitcoin at for this new one, and therefore you need various bits of information from the buyer and the seller, obviously, to be able to maintain that. So that hasn't been received very well, obviously, by sort of the general DeFi fan party that is cryptocurrency investors. But hey ho, we will have to see how that comes through. But generally speaking, there's been a lot more, as I say, a lot more liquidity being pushed into it at the moment. I mean, another one, just to reel off a couple of others, Golden Tree, which is a New York-based asset manager, 45 billion under assets. They've been adding, similar to the German funds thing. They've been adding cryptocurrency as more of a hedge, a wealth front as well, which is sort of an automated investment solution over in the US, which is fairly big, sort of similar to Nutmeg and that kind of thing over here. They've added what they call the Grayscale Bitcoin Trust and Grayscale Ethereum Trust into their menu of investments, they call it. So essentially, that's setting up almost a robo-advice type solution for crypto stuff over in the US, or at least exposure to it in some shape or form. So that's crazy. That's really, that's if we'd said that a year ago, 2 years ago, was on the cryptocurrency topic, that's coming along somewhere, isn't it? So it's certainly pushing its head through more into more and more of a main asset class.
I think that's always the risk, isn't it? It's the regulation risk. It's much like with any early stuff, or when we come on to stocks and China, anything which maybe is less well established. The bigger companies tend to be less volatile. Smaller things have more risks in that. As things develop over time, there can be bigger impacts you just don't foresee. But I think you're right. I think some more bigger institutional money is very interested. I think if you're looking at Cathie Wood and the ARK funds, I mean, they have a target price of $500,000 for Bitcoin, and they're talking about over the last few weeks it been in a capitulation phase, where the initial, bit like what happened before, the initial sort of steam runs out and then it sort of capitulates. But I think those cycles can be extreme and for long periods of time. So even if their target is 500,000, you don't know what that time frame is. Particularly, they're talking about extending their time frames for all assets. So I think we're just going to see more volatility going forward, and cryptos just play a part in that. And again, we might be talking about cryptos because it's interesting, gives us plenty of content for this podcast. I don't think either of us are saying, like with the funds putting the potential to put 20% of assets in there doesn't mean those funds are putting 20% of their assets in there. It's just the same as any fund. It is capped at 20% in any investment. It just gives them scope to use it. I think Ruffers have been putting, say, 1% in there, and I think that's more the general consensus. If you want to dabble in it, then 1-2% is maybe okay. I think anything over there, or even doing it on that level, it is more speculative, regardless of whatever reasons you have. But interesting topic all the same. But talking about regulatory risks, I think stocks, and particularly Chinese stocks, have suffered quite a bit over the last however many weeks, with more risk of legislation. But there's been a bit of a change in mood in China, wanting to work with Washington a bit more. But again, I think we're just going to see more volatility on that kind of macro global economic policy bartering, both on a pseudo COVID front and for other economic reasons. So yeah, there's definitely the world is less harmonious at the moment. But I mean, Tim, I think you've got some stats about the US stimulus package as well, haven't you?
Yeah, well, yeah, yes and no. But yeah, generally speaking, it's, as you say, it's more just range bound activity, isn't it? Particularly in the UK, it's just FTSE is around 7,000, has been for, well, actually, let's look to a minute ago, around 100 days now. So a good few months, it's just been up and down around there. But it's a stimulus packages, the market waiting to see, what's solidified, what's not. In the meantime, of course, depending on this tweet, that tweet, who said this, who's indicated that, indicated this, we're going to see technical bounces in the market here, there, and everywhere. But until something solid comes out the back of it, then there's not going to be more of a solidified move.
We're in more of a circling formation, and I think unless we get some, like you say, when one of these packages comes through, or we get some erroneous COVID stats that cases have gone through the roof and then countries are locking down, or not, as the case may be, and actually everything's going fine. I think till there's some more solid economic data, it's all very steady eddy, and I think that's why you're seeing markets just risk off a little bit till they get more information now. But interestingly, I think there was an article saying in the FT8, I think it's an 18-year high for analysts to be giving buy recommendations. So even if it does sound gloomy, I think markets in general are still positive. You'll always hear all the bad news, but I think in general, there are good economic things to come through. There's a lot of demand, and that's why we're seeing shortages in terms of timber, raw materials. We've talked about inflation so many times, but I mean, you can't use even used cars, the worst asset class of all time, pretty much, bar the classics, are maintaining prices pretty well. So yeah, you definitely know something's up if a known depreciating asset is still holding its ground. So yeah, just got to get through this next period, but I think overall outlook is positive. It's just with a bit of volatility and a bit of going round in circles in the short term.
Yeah, waiting in the short term, as you say. Yeah,
good.
Brilliant. Okay.
Hopefully that gives you a market update of nothing to report, really. But until next time, yeah. Take it easy, and if you need help in navigating some of these volatile times, then come and speak to us.